Welcome back to Deep Economic Thoughts. This is Ivan Alon, the founder and chief investment officer at Align Wealth Advisors Investment Management, also known as AWAME. This month, July 2024, I submitted my article to Forbes, and the subject is dealing with how two parts of our capital markets are kind of on different pages, the fixed income market and the stock market. And specifically, and this is also on the Align Wealth website, alignwealth.com, A-L-I-G-N-E wealth.com. There's a link in the description of this episode to this research highlight that contains a couple of the graphs that are referred to in this month's Forbes article. And essentially it's looking at the high yield, U.S. corporate high yield market versus the Russell 2000, which is a small cap stock index. And what's very interesting is if you take the high yield market at face value, what it is saying based on the option adjusted spread, which very simply, an option adjusted spread just means how much more reward do you get by holding a high yield bond of a certain credit rating versus a risk-free bond of a similar duration, of a similar maturity. And right now, that is compressed. That spread is very, very narrow at around 187 basis points, whereas the longer term average over the past few years has been around 261 basis points. So almost, a full 100 basis point spread. It's about 80 basis point spread. Lower than the average. So this is a very, very narrow spread, and narrow spreads usually mean very low risk perception. So the high yield, the corporate high yield market in the United States, and specifically I was looking at BB rated bonds, which is the first rung on the below investment grade ladder. That is essentially saying, market participants in that part of the fixed income market do not really see a tremendous amount of default risk and therefore not a lot of recovery rate issues. And that's a pretty nice thing to see. People are not overly concerned, apparently. However, if you take a look at the stock market, the Russell 2000, and the reason why the Russell 2000 is so good to look at is because 90% of the Russell 2000 is rated below investment grade, which makes sense. These are small cap companies. They're growing. A lot of them don't have profits yet. But of course, that's where leadership of the future comes from, typically. And also over very long-term averages, you see that small cap stocks outperform large cap stocks just because of this growth dynamic, usually early adopters of technology and other kinds of innovations to create more efficiencies in their businesses. Also, you have a lot of M&A activity right now going on within small caps, which actually is a very healthy market dynamic to have. But anyway, Russell 2000 has essentially an earnings yield. So you take the price earnings ratio of the Russell 2000, flip it on its head, put earnings over price. Right now that's hovering around 7% earnings yield on the Russell 2000. Well, meanwhile, a BB corporate bond is currently yielding 6.33%. And like I was going to say, the Russell 2000, 90% of it is below investment grade. So this is looking at an equity index versus a fixed income yield that is primarily dominated with junk bonds, junk bond status or low credit quality rating, and you're seeing a much higher yield available, earnings yield available on small cap stocks, and yet small caps have just performed so terrible over the past certainly couple of years. And specifically in the research highlight, I take a look at what's been happening since 2021. So looking at 3 years, the high yield, corporate market, as indicated by the Bloomberg U.S. corporate high yield, is up about 5% in terms of total return. However, the Russell 2000 total return is negative about 7.5%. So this is a 1,200 basis point differential, more than that. Huge, huge difference. And the question is, which market is right? Is the stock market correct on what the forward-looking risk is? Or is the fixed income market correct, that there really isn't too much to be concerned about? And in my own experience, and having started my career in the fixed income side of the industry, working at Nuveen Investments at their headquarters in Chicago, and they moved me out to California in the 90s, I've always thought that fixed income investors tend to be more sophisticated. Not the retail fixed income investor, but the institutional one, because it's not a very transparent market. It's matrix pricing, it's inter-dealer trades. There's no single exchange where you can get price discovery. There's more credit analysis and understanding of the underlying financials. So I'd like to think that the fixed income market is indicating a very rosy outlook, or certainly not one that is dire. And that's nice. And that would mean that small cap stocks in particular are really prime for a heck of a rebound to perhaps catch up with where large caps have gone. And so large caps may kind of stay where they're at in terms of their valuations and pricing in the market, but then small caps are able to catch up. But there is this really differential and dichotomy in opinion of a forward-looking risk between these two markets. And so that's the point of this month's Forbes article, is the point of this month's research highlight. And of course, this is very important to us here at AWAME because we have an overweight, in small cap stocks. And we have very little relative investment in our total portfolio suite to large cap U.S. stocks. And we're just not comfortable. We don't have an appetite for the amount of concentration risk that currently is present in the market cap weighted S&P 500. Where, it's, I think I read a statistic today, 36% of the S&P 500 is in just a few, companies, the top 10 companies. That's a tremendous amount of concentration, and we have seen this concentration occur before, and we have seen concentration of top 10 stocks, for example, in 2018, where the top 10 contributed more than 100% of the S&P 500 return for the first half of the year. So this is a phenomenon that does occur, where you can get tremendous concentration, a few companies really driving the majority of the return. That's too rich for our taste. And so we divested ourselves out of that more than a year and a half ago. And we were happy to do it because we like to sleep at night and we don't like having the potential of waking up in the morning here in the Pacific time zone, to the news of the S&P 500 being down 35% from its lofty valuations. And, obviously we have to make those adjustments in our portfolios. And that's what we did. And so we have been, in a very real way, underperforming, certainly our benchmark over the past year. And that is actually kind of typical for us. We tend to be, as I evaluate and look at the discipline over a period of time, we tend to be a bit early in our positioning ahead of market events. And that was the case certainly in 2020 with our high yield trade, and in 2022 with our ultra short duration positioning. And so therefore our bond portion of our portfolio really held its value incredibly well relative to the U.S. bond aggregate index. And so here we are again with our positioning in overweighting in small caps and really more of an equal weight approach to the S&P 500, and being patient and really understanding that underlying fundamentals and financials ultimately do matter in the market, especially when things get even more uncertain and perhaps more murky in terms of what the outlook may be. Because who knows if the fixed income markets are really right in their assessment that there's very little risk on a forward-looking basis. If they are right, okay, small caps are going to have a really great day and a really good outperformance potential relative to large cap. But what if they're wrong? Well, if they're wrong, we're overweight significantly right now on cash in our portfolio suite, and that is an opportunity to go and buy potentially some very good yielding bonds that would have seen their option adjusted spreads expand significantly. And they certainly have done so in the past. We've seen them go up 700 basis points, 1,400 basis points. During times of crisis, you can see spreads expand quite significantly, and that would be a very logical place for us to allocate, all things being equal, from our cash positions and ultra short duration treasury positions into these particular opportunistic areas in the fixed income market. And since there hasn't been a lot of great performance with small caps, they just kind of tread water. And we think the relative value will be held compared to large cap companies, which have certainly very, very extended valuations as compared to small caps or even foreign stocks. So that is my episode for this month. And of course, if you've got any questions at any time, always feel free to reach out to us at info@alignwealthllc.com. That's info@alignwealth, that's ALIGNE, wealthllc.com. And also visit our website for more information at alignwealth.com. That's ALIGNE, wealth.com. And thank you very much for listening to this month's Deep Economic Thoughts.